Welcome to Insurance Leadership Conversations. I'm excited today to have with us a very special guest, Dr. Robert Hartwig, currently professor of risk management, insurance, and finance at the University of South Carolina. And you may know him as the longtime president of the Insurance Information Institute. Bob is also a member of our board of directors, and we're very honored to have him with us today. Welcome, Bob.
Very glad to be with you, Carl, and thank you for having me. And it's a special treat for me to be on this webinar today. And in addition, it's also been a wonderful experience for me to be on WSRB's board for the past couple of years. It's been an honor, and in fact, really a privilege, because I get to be sitting there with some of the best minds, I think, in Washington State and really around the country, who are thinking about a lot of cutting edge issues related to risk that we're going to be talking about later today. Whether we're talking about wildfire, whether we're talking about risks associated with cannabis or what have you, a lot of innovative risks like that. These are the sorts of things that we're working on at WSRB on behalf of the industry to make sure that the underwriting that goes on in Washington State and beyond is as best as it possibly can be. So thank you for having me on the board.
Excellent, Bob. Thanks so much. We're going to tap in today to Bob's experience and expertise as a PhD economist, expert on the insurance industry, the economy, and how it impacts the industry. So just to kick this off, Bob, please walk us through the property casualty insurance industry's financial performance for this past year, 2023, with an eye toward what 2024 might hold for us.
Right. So 2023 was another tough year for the property casualty insurance industry, and as was 2022 and 2021. What all three of these years have in common in this kind of post-COVID era are record or near record catastrophe losses. And we're talking about, on the West Coast, wildfires; on the East Coast and Gulf Coast, we're talking about hurricane-related activity; in the Midwest, very strong hail-related events and tornadic events. And then this is compounded by the fact that events like these are going on around the world, which puts a little pressure on reinsurance markets. So we'll talk about that later. Last year, 2022 in particular, we also had a very tough year for the economy. We saw interest rates rise. We saw inflation rise to levels we hadn't seen since the 1980s. And this caused investment performance to suffer. So when you deprive insurers of some of their investment earnings, and you compound the fact that claim costs were rising very rapidly because of inflation, you wind up with bottom line pressure for P&C insurers of a type that it's very difficult for them to, in fact, anticipate. Because we hadn't seen inflation along the line of 8% in more than 40 years, well, that meant that simply rates did not have the expectation of claim costs, claim severities rising at a pace, not just at 8%, but we found that across commercial property, across residential property, and in the commercial and personal auto lines, we saw inflation rates that were really almost double the overall inflation rate in the economy. So this has driven up claim severities across the board, and the industry is playing catch up right now. That's affecting results in 2023. It will continue to affect results in 2024.
What would you say the outlook is for the overall U.S. and global economy for 2024? What does this mean for property casualty insurers, would you say?
The outlook for the global and U.S. economies in 2024 is there's a fair amount of uncertainty. And so we haven't completely left behind the uncertainty that really got going under COVID, but it's a different kind of uncertainty that we have today. We have a lot of global geopolitical risk out there. We have a big election in the U.S. that may change the direction of what economic policy is in the United States, and similar sort of political events that are occurring abroad. But we're still recovering from 2022, which was the period where we had the highest inflation. Inflation reached 8% overall in the U.S. economy. That's the highest we've seen since 1981. And what that did wind up driving up claim severities, particularly in the property lines as well as the auto lines for property casualty insurers, both on the commercial side and on the personal line side, at a pace that we had not seen in many, many years. This was entirely unanticipated. There's no way insurers in 2021 could have known that inflation was going to be 8% in 2022. And it would take the better part of 2023 to get that under control. And that would require interest rates to be driven up as high as they have been by the Fed. And when would the Fed then begin to bring down interest rates? An answer we still don't have right now. So speculation would be that the Fed begins that at some point, maybe in the second quarter of 2024. But the pace ultimately is unknown. So we are dealing with, again, a lot of economic uncertainty driven by the path of interest rates and the path at which inflation will ultimately subside. The good news, and the very, very good news, is it does appear that we are resolving both the inflation issue without derailing the U.S. economy. The economy is expected to slow in 2024. That means slower growth for property casualty insurers, but in such a way that we do not enter a deep recession, or maybe avoid a recession altogether. That is the so-called soft landing scenario. Some people talk about it a Goldilocks type scenario, and so it's a situation in which the industry is likely to slow as the overall economy slows, but we don't see a collapse, for instance, in the investment environment like we saw in 2022. So for property casualty insurers, and quite frankly, for the clients of the property casualty insurance industry, businesses in every industry, this is the best possible scenario for the year ahead. So I'm relatively optimistic. Of course, we don't know what's going to happen with catastrophe losses, but I think we have a good sense of what the trajectory is on inflation.
Thank you, Bob. You touched on this a little bit. Does the fact that 2024 is an election year and you have candidates that have very differing viewpoints about how to approach the economy and regulation and overall governance, does that inject any additional uncertainty into your forecast? Does this high degree of political uncertainty impact your outlook for the year ahead?
There's no question that the high degree of political uncertainty that we're seeing run up to the 2024 presidential election is going to have an impact on economic policy in the United States, and how that translates down into how individual corporations, all of which are clients of the property casualty insurance industry, how they operate their business. For instance, it's going to affect their hiring plans. That is going to directly affect workers' comp payrolls, which affects the exposure base for workers' compensation. It's going to affect plans related to business investment, which is very sensitive to interest rates, for example. We have other issues out there as well that are international in scale, related to trade policy, tariffs, quotas, all of those sorts of things. So those are going to affect the insurance industry's ability to grow both domestically and internationally, really for the next 4 to 5 years, and then beyond, of course. We have other issues and beyond that. I mean, with whatever presidential administration takes control of the White House starting in 2025, are they going to be fiscally disciplined, or are they going to be as undisciplined as administrations have been over the past several decades, running our deficit up? Is that going to push interest rates up? What impact will that have on investment and investment opportunities, investment costs for businesses, and investment returns for individual investors in the years ahead? So I would say there's a fair amount of investment uncertainty. However, I have examined all the way back to the 1950s what the impact is on returns on equity for the property casualty insurance industry. And what I have found is that, believe it or not, it makes no difference who's in the White House. So in other words, the average return on equity is roughly the same throughout Democratic administrations as well as Republican administrations. I'm referring to who's in the White House here, as opposed to the composition of Congress. That may be an interesting finding to some, and I roll that out every year and I update it every 4 years. Most people come down on one side or the other. Very few actually guess that it doesn't make a difference. And the reason for that is that the major determinants of the industry's return on equity over long periods of time don't have much to do with ever who's sitting in the Oval Office. It has way more to do with what is going on in terms of the frequency and severity of major natural catastrophes, for instance, which absolutely do not care who's sitting in the Oval Office.
Do you see a continuation of the hard market, or is some softening to be expected?
Carl, we've talked about some of the challenges of the past few years related to inflation and high catastrophe losses. Elsewhere, we've heard a lot of discussion about abuse of the legal system. All these things suggest that there's going to be a continuation of the hard markets in 2024. Again, so whether we're talking about property risks, whether we're talking about liability risks, or whether we're talking about commercial and personal, all things suggest that we're likely to see a continued escalation of rates in 2024. Now, a little bit of the edge could be taken off of that for a couple of reasons. One, inflation in 2022, which was 8%, is expected to be closer to 2.5%, 2.8% in 2024. That helps reduce the pressure on claim severities. It's also the case that reinsurance costs, which have had a huge run up over the past few years, are beginning to moderate as we look as we examine the 1/1/24 renewals. So that's good news as well. Now, we haven't solved the abuse of the tort system or abuse of the legal system problem here in the United States. We still have trial lawyers run amok, and that's going to be a huge problem that's beyond just the property casualty insurance industry to solve. But all of that said, I think we're looking for continued moderation of continued hard market conditions in 2024, but with a moderation relative to the last couple of years.
So when we talk about, you touched on that, the idea of tort reform, do you see some bright spots? A lot of this ends up being at the state level, I believe. Do you see any bright spots in the country for that?
I think abuse of the legal system is something that's extraordinarily pervasive and is worsening in the United States. As you know, much of this is driven by actions of individual state legislatures, some of which have been entirely captured by the trial lawyers. By that, I mean they're effectively run by the trial lawyers. So the trial lawyers make rules, regulations, statutes that benefit themselves. It's no accident that across much of the United States, you can't go 2 miles down the road without seeing billboards for trial lawyers or hearing ads on the television or the radio or these days on the internet. The trial lawyers are the best organized, best funded special interest group in the United States, bar none. And they are very well organized. They target specific groups. For instance, they target the trucking industry, for instance, right now is very much in the crosshairs. We see pharmaceutical companies. We see many others. And so the question is, how does the insurance industry deal with this? Well, we're an important part of the economy, but at the end of the day, this is not something that property casualty insurers are going to be able to solve on their own. It really requires a lot of grassroots efforts at the state level and also some efforts at the federal level. Try, for instance, to get legislation passed that would impose caps on certain types of awards, for instance. It would rein in the ability to for plaintiffs to argue that they should be awarded damages in the form of bad faith damages, for instance. This is a problem in a number of states throughout the country today. And historically, this involves working at the local level with industry groups, chambers of commerce and such, trying to identify areas where we might get the most bang for the buck. So again, a good example right now would be there's this whole problem of what's called third-party litigation funding, where you can literally invest in a lawsuit being filed against the corporation. And then, as strange as that sounds, that's actually an investment opportunity that exists in the boat. But the reality of it is, in most states, the jury, for instance, has no idea that some third party who has no insurable interest in the case is investing, is basically throwing money at the trial lawyers who are running the case in order to profit from it. And when they learn about that, it bothers them. Okay. So making mandatory disclosures there is one area where insurers have met with some success. But apart from that, it's hard to point to a lot of areas of success in terms of the area of reining in abuse of the tort system.
And as long as that is part of the picture, I think that remains very challenging for us as an industry. Switching gears and pivoting a little bit, we look at that aspect of it, where we need tort reform at the claims level, reinsurance affects the industry significantly as well. Could you walk us through the reinsurance markets and kind of where we stand as an industry in relation to reinsurance at this time?
It's the United States is the biggest reinsurance market in the world, and some of the cat-prone parts of the United States, like Florida and California, are some of the largest reinsurance markets, not only in the United States but in the entire world in and of themselves. But we've seen no shortage of large-scale losses in these areas from a variety of events. Obviously, again, wildfires on the West Coast, for instance, uh, uh, tornadoes and hurricanes and such in the eastern half of the United States. This is a multi-year situation with climate change. People expect this to be normal. So no one is expecting that the frequency of these events is going to decline or that the severity of these events is going to decline. What needs to therefore happen is more capital needs to be attracted to reinsurance markets, and that is happening. That is happening both through traditional reinsurance, the major reinsurers that operate on a global scale, and many of which are based in Europe, Bermuda, places like this, but also by increasingly tapping the capital market. So an ever larger share of reinsurance capital is actually coming from large institutional investors around the world who expect a very high rate of return associated with this investment because it's pretty risky. But nevertheless, that capital is flowing in, perhaps not at the pace as that we would like it to, hence the very substantial increase in the price of reinsurance we've seen over the past several years. But it is increasing nonetheless, and it's going to be ever more important. But I do have faith that on a global basis, there is enough capital to reinsure the risks here in the United States and around the world, despite the threats that we face.
That's encouraging. Thank you so much, Bob. As we wrap up our time together, I have one last question. What's your overall investment outlook for 2024? Not only for us as an industry, but certainly the folks who are watching us today have personal investments. Overall, what do you think? How's that looking? High interest rates certainly can be a benefit, but they can also be a drawback at times as well.
Well, absolutely. And I wish my crystal ball were crystal clear, Carl, because I'd be the world's richest man by the end of 2024. But I'm actually fairly bullish on 2024 for a couple of reasons. Number one is there's essentially 100% unanimity that the Federal Reserve is going to begin to lower interest rates beginning at some point in the first half of 2024. And that's probably going to continue throughout the year and into 2025. Generally speaking, an environment rates are rising is bullish for stocks. It's also something that would lead to an increase in value of bonds held in existing portfolio. Both of those are very, very good for insurers, which are among the largest institutional investors in the world, but it's also good for individual investors. Lower interest rates will likely improve the expectations of consumers and businesses alike, who will see that this is the time to invest. This is the time to buy a home, perhaps buy a car. All of this is stimulative ultimately to the economy. The Federal Reserve is going to take its time lowering interest rates. I hope that it does. First, because we want to make sure that inflation is indeed vanquished, but also this will help the economy recover, but not in a way that'll send the economy soaring in such a way that'll rekindle inflation. We want to do this very carefully so that we achieve this soft landing scenario, which, by the way, we've only achieved one soft landing in the past 40 years or so. So these are kind of rare things, difficult things to pull off. But all the indicators are right now, and all the sort of political uncertainty, notwithstanding, the indicators are that 2024 could be a good year for institutional investors and personal investors alike.
I'm encouraged that there's a possibility we could pull off a soft landing. Thank you so much, Bob. Really appreciate you joining us today. Thank you for helping us as an industry understand these complex issues and continuing to do the work you do to educate that next generation of insurance employees as well. Hopefully some of the folks coming out of your classes will be joining us in the industry, having been given a great foundation by you as you teach them how risk management works. So thank you so much. Really appreciate the work you do with us as well. and really appreciate the help today in understanding our economy and how it impacts our industry in the coming year.
My pleasure, Carl. Anytime.
So now we're going to go to a live Q&A, and on your screen, either below this window or to the right, you'll see a Q&A button. And so please jump in, ask some questions. We've got one right now out of the gate. Does the latest news of Boeing create a ripple in the economy, or could it? That's the first question for you, Bob.
Well, hello there. And can you hear me, Carl? Just want to make sure. Okay, good. All right, good. So, Boeing, obviously a very important employer in Washington State. And as you heard at the onset, I'm at the University of South Carolina. It's a big employer here in South Carolina, too. This is where they make the 787 jets and down in Charleston. So we're connected in that respect. So, Boeing employs 156,000 people. It's one of the biggest employers in the country. It generates tens of billions of dollars of revenue on an annual basis. And the short answer to the question is yes, the latest news. And there's been a lot of news about Boeing recently, and has not been good. So there's the latest news and the latest news. We can go back to prior to COVID, and had a crash a couple of the MAX jets, which were grounded for quite some period of time. Those came back. COVID hit, that hurt them for a while, but then incredible, coming out of COVID, incredible demand for jets. So that was good news for Boeing. But then, of course, just in recent weeks, with the door plug flying out of an Alaska Airlines flight. So that's a concern. And many companies having to ground their jets, and questions about quality control at Boeing. I mean, what are the potential economic ramifications for that? Well, there are a couple. For instance, we heard that United Airlines, which is the biggest operator of Boeing jets in the U.S., has a big back order for Boeing jets, is thinking of looking elsewhere potentially for partners, and elsewhere would mean Airbus. So that's not good news for Boeing. Boeing also has a huge backlog, I believe, of over 3,000 jets over the next several years, and it wants to ramp up production, but it's been told by federal regulators that it can't do so, and it's not being allowed to do so because of the controls of quality control issues. So there's not a belief right now, anyway, on the part of regulators that Boeing can safely ramp up production without compromising safety. Now, hopefully, over time, Boeing will be able to convince regulators that that's the case. So that is holding back hiring. That is holding back expanding and building new facilities. And it's holding back potentially sales of the jets in a timely manner. And longer run, the concern would be if they don't get these problems behind them to the satisfaction of the world's airlines and the world's aviation regulators, you wind up ceding more market share to Airbus. And again, so that's bad news for Boeing. It's bad news for Washington State, South Carolina, and the entire United States. So let's hope that Boeing, I hate to say it this way, but can get their act together, because right now, the experience of the last 5 years has been some very significant issues. Was there so another question, Carl? I think maybe.
Yes. Next question. Could you talk about a soft landing a little bit? What are the key indicators that a soft landing is in fact happening, and vice versa? What would a hard landing look like? Is the question.
Right. So, well, a hard landing, just like in a real aircraft, you're gonna know it. Okay, you're gonna come to a very abrupt kind of stop, maybe be thrown back in your seat a little bit. It's going to be uncomfortable, and you're not going to want to repeat the situation anytime soon, because it's going to be scary. And so from an economic perspective, a hard landing would be represented by a kind of a sharp and sustained upward increase in the unemployment rate, for instance, and a very sharp and sustained reduction in the pace of economic growth as measured by real gross domestic product. So what does that mean? That means that the unemployment rate goes up and the economy falls into a recession. That's what we would call a hard landing. That scenario appears to be off the table. I'm glad to actually be able to say that even the soft landing, in some sense, where the economy slows down just enough and maybe has a bit of a downturn, almost that is increasingly a less likely scenario, but I mean that in a positive sense, because the scenario that's perhaps becoming more likely is the no landing scenario, And by that I mean is that the economy continues to glide at cruise altitude, maybe not quite as high as it was before, but a bit lower, but nevertheless continuing to cruise along. And in fact, we just ended 2023 with statistics in terms of labor markets and GDP growth that were much, much stronger than anyone anticipated. And so some of that growth will carry over into 2024, both US and domestically. So that's good news there. So the soft landing scenario, again, you would expect to see a very modest rise in the unemployment rate, a very sort of a modest slowdown, or maybe very, very tepid economic growth. What I think most people across the country will experience is, depending on where you are, you might feel the soft landing scenario. Other parts of the country are growing much more rapidly and have stronger economies than others. So the Southeast, the mountain states, for instance, will tend to kind of continue to soar, and some other parts of the country, particularly say the Northeast and the Midwest, might feel the soft landing scenario a bit more. But the good news is overall for the U.S. economy, relatively strong performance, all things considered, for 2024.
Okay. So we have a question next that actually has a number of votes from attendees. What impact does the Davos group, the WEF, have on our economy in the U.S.? That, of course, just happened recently. What's the impact, if any?
Well, without trying to be too cynical, the world's smartest people go over to Davos every year, and they're very good at predicting what happened last year, and less good at predicting what's going to happen in the year ahead. So this year's discussion was all about AI. That's what dominated things. The year before, people were talking about inflation and the war in Ukraine and things like this. And obviously, things like climate change are a very big topic there. So, in terms of influencing the economy, you don't see much in the way of what I would say, consensus evolving in Davos that's going to influence, how global public policy makers operate. Maybe you get a little bit of an insight into their minds and the minds of business leaders, but I think that what you tend to see a lot of very broad thinking in a place like Davos. So if you listen to the discussions about what we might do with respect to AI, and you saw Sam Altman, who was the CEO of OpenAI, who was the CEO and he was fired and he was rehired again. Microsoft, of course, being a big part of the economy out in the Northwest. Mm-hmm. I think the initial effects on the economy, let's say, of AI have been to see about 7 stocks on the New York, that are traded at the NASDAQ or the New York Stock Exchange drive up those indices very rapidly at the end of 2023 and even extending into 2024. So there's this view that, AI is the wave of the future. Everybody's going to invest in it. It's going to fundamentally change how we work, how we live, all these kinds of things. The reality of technological change has been that it actually tends to occur much more gradually, whether we're talking about the internet or electricity or the internal combustion engine or whatever it is. So it's there. So there's a lot of thinking about AI, which certainly has a great deal of potential in terms of changing how humans, live on a day-to-day basis, how we work. But you don't have to look very far to see that, there's still a traffic jam. And AI hasn't solved that problem. There's still air traffic control problems. So the day-to-day problems of, how to get through the checkout line optimally in the grocery store, we still haven't solved that problem. But to be more concrete, the timeline for such things as autonomous vehicles has been pushed back much further. And everyone thought by 2025, everyone would be driving around in autonomous vehicles. And quite frankly, we aren't even close to that yet. So AI has a lot of promise, but you have to kind of balance the promise with the hype. And so you get a lot of hype, I believe, at Davos without the amount of realism that I think that we really need to try to understand, where these sorts of technologies are going us.
That makes some sense. Absolutely. So for our attendees and our guests, take a look at the Q&A. There's an opportunity there to vote if you have a particular question you'd like to hear more about. So jump in, because we will probably run out of time before we run out of questions. But here's the next one. It gets back to our unemployment and inflation issue, I think, Bob. What is your forecast for unemployment rates in 24 and 25? It seems like taming inflation will be a difficult challenge if the unemployment rate remains at historically low percentages, or is unemployment no longer as correlated with inflation as it once was?
Yeah, so to answer the first part of your question initially, so, we ended 2023 with unemployment rate in the 3.7, 3.8% range. In fact, it's been under 4% for 2 years now. But the expectation is, with a bit of a deceleration in the economy and what I would call a normalization in labor markets. In other words, ever since COVID, labor has had sort of the upper hand here. Large numbers of people quitting jobs, wanting to work remotely. Managers are going to get a little bit more of the upper hand in 2024. And what we'll begin to see is just an incremental increase in unemployment, so that we could see unemployment, again, ending 3.7, 3.8% in late 2023, perhaps approaching 4% or so as we get towards mid-year. That's still a very, very low unemployment rate. The Federal Reserve actually believes that it needs to have the unemployment rate somewhere around 4.1% to avoid the magnitude of pressure on the labor markets that contributes significantly to inflation overall, which was part of your question as well. So while we don't ever want to see the unemployment rate rise, there are some circumstances where it does make sense and where it's actually helpful. There's no question the labor market today is as tight as a drum. It's still very, very tight. It's still pretty easy for people to get jobs, although, again, we hear about layoffs in the tech sector, which absolutely overhired in the wake of COVID. But if the unemployment rate rises from 3.7, 3.8% to 4.1%, because more people are entering the labor force, then that's actually a good thing. And what that means is the supply of labor is increasing. So you can actually have the unemployment rate rise without job losses. Generally, people think that the only way that the unemployment rate goes up is when people get laid off. You can actually have the unemployment rate rise when you have more people coming into the labor force. And it'll take some time to get to hire and absorb some of those individuals. So that's actually not necessarily a bad thing, and that's something that can help temper the pace of wage growth, which I know people don't want to hear this, but wage growth right now is at a level that is real wage growth actually exceeding inflation, is a bit above where the Fed would like to see it in order to be consistent with its overall 2% rate of inflation that it's looking for.
That makes some sense. That's excellent. So our next question, thank you, Bob. Our next question, and I'm looking back here, I think it's on that same topic. Let me scroll just a second. Do you think it's realistic to expect inflation to get back down to prior levels? Is 2% reasonable? That's our next question.
Yeah, and that's a very good question. Certainly, that's what the Federal Reserve is angling for. It is everywhere and at all times saying it wants the overall inflation rate to drop to 2%. The Fed does follow, but when the Fed's talking, yes, you might be thinking they're talking about the consumer price index. That's the rate of inflation that everyone talks about. But the Fed has other measures of inflation. Personal consumption expenditure inflation, for instance, which is actually its preferred measure of inflation, and there are a number of measures of inflation right now that are closer to 2% than the current CPI, which is running a little above 3% now. The CPI is expected for full year 2024 to wind up somewhere around 2.6% and maybe just a bit below that in 2025. But there will be enough other indicators related to inflation that I think the Fed will be satisfied. The Federal Reserve right now is on a trajectory to begin likely lowering interest rates around mid-year, but I think incrementally, not by, in other words, by say a quarter of a point, not by half a point or 3/4 of a point, which is what the Fed was doing when it pushed rates up very quickly beginning in 2022. And the reason for that is the economy has turned out to be stronger, both in terms of economic growth and labor markets than was originally anticipated. So the Fed will be looking for various signs of weakness in the economy, and that will, calibrate the pace at which it's going to bring rates down. But right now, the view is, higher for longer in terms of interest rates, but that doesn't mean that rates are not going to fall. They will. And the Fed is going to take a very measured approach on this. There is no reason, if as long as the economy is on a glide path to something approaching a 2% inflation rate by some of the measures most closely followed by the Fed, I think the Fed will bide its time. And that's actually good news from an economic perspective. You already see people, for interest rates have already come down a bit. You see people getting back into the market in terms of applying for mortgages, which means home sales and home building will likely be favorably impacted. New car sales, industrial and business investment, refinancing by business interests, even relatively modest decreases in interest rates associated with being on the right glide path down to the 2% inflation rate are going to be very beneficial to the economy.
Excellent. Thank you. Last question, and we have more like I thought we might, but this is a pretty big question to answer in the 3 minutes or so that we have remaining. But how do you see potential escalation in the Middle East and perhaps increasing tensions with China affecting the economy in the future?
Yeah, so these are, big questions. Here we are with the sad events of American servicemen and women being killed abroad over the weekend. And obviously, there's going to be a very, I would say, forceful response on the part of the U.S. The immediate impact of something like this, as always, and it's already begun, is an escalation of oil prices. And we've seen that, and that can, set back the fight against inflation a little bit. We'll likely see there'll be an adverse impact of inflation in the January CPI when those numbers come out in February. So that's unfortunate, but hopefully that's a temporary effect. Even predating that, though, we have Israel's war with Hamas, and that's an ongoing consideration, which causes a lot of instability and causing ships to go halfway around the world to get to Europe, those sorts of things. To quickly wind up, though, with respect to China, China's economy has weakened. It's looking to stimulate its economy. It's looking to dial back the pressure in terms of the saber rattling with the United States. That's actually a very good thing. And so the biggest danger with respect to China is, there's the danger with Taiwan and getting into an out-and-out hot war with them potentially. Hopefully that can be avoided. What is almost a certainty, irrespective of who wins the election in November, is an intensification of a trade war with China, and with higher tariffs being levied against Chinese goods. And that's going to be a lose-lose situation for the U.S. And for China. Americans very much love their inexpensive goods that are imported from Asia, the majority of which are imported from China. And they will quickly come to be shocked at how much those cost if we wind up in an out-and-out trade war with our one of our largest trading partners.
Thank you, Bob. Thank you so much for being with us. Thanks for the questions from the guests. We so appreciate your insights, and we hope to have you back at some point to talk with us again.
My pleasure.
Well, thank you very much, and we will look forward to seeing you soon.
Thank you. You too, Carl. My pleasure.
Excellent. So we have a really quick special announcement to wrap this up. Our subscribing insurance companies have some great opportunities going forward to take advantage of a new set of tools that we've developed. And rather than trying to summarize it live, we cut a little video for you. So we're going to roll that now, and then we'll be back right after for 2 quick minutes, and we'll wrap up. We're excited to announce a new product offering that will help you underwrite more effectively, leading to more profitable business. Our Building Metrics suite of risk assessment tools is now available to you in every state where you do business.
helping you identify risks hidden in your book. Most importantly, because these risks are hidden, you either don't intend to cover them at all, or if you do, you aren't charging the right premium to pay the eventual claims. These risks include cannabis, hemp operations, adult family homes, home daycare, federal firearms dealers, vape operations, historic properties, unreinforced masonry structures, underground storage tanks, and any location with an increased risk of wildfire or earthquake damage, with more to come. I've heard it said that people are tired of trendy insurtechs and companies pitching big data. Well, that's true. What they're really tired of is trendy ideas that won't get past regulators, hundreds of data points underwriters just don't have time to look at, and data dumps that overwhelm the IT department. What they really want is a curated experience, curated data that pinpoints action you can take today that will help you write profitable accounts and help you serve your customers with excellence. It's information that cuts to the heart of risk from insurance people who know what it's like to get filings approved, sell policies, underwrite effectively, and handle claims. That's what you get from WSRB and the Building Metrics suite of risk assessment tools. So what's next? We want to ensure that you get every question answered and that you're fully set up to take advantage of the tools and resources that are available to you as part of your subscription. To learn more about how we can help, explore the resources below, and please join us this spring for our first educational webinar on the Building Metrics suite of risk assessment tools.
So you'll get another chance to get those resources when we send you an email here in the coming days. We're very excited about this. It's available at no charge to our subscribers, but it is also available to non-subscribers. So if you're with a non-subscribing company, you'll want to take advantage of this as well. And to help you understand this better, our data solutions manager, Scott Elliott, will be doing a webinar here coming up in the spring, and you'll get more information about this. So keep an eye out for that email. We're looking forward to seeing you. Thank you so much for being with us today, and we look forward to adding more value to you going forward. And we wish for a very prosperous year for each of us and our companies. Thank you.